Hello, and welcome to this episode of Nucleus Wealth Empower. I'm Shelley George, Chief Operating Officer at Nucleus Wealth, and I'm coming to you today from the lands of the Wurundjeri people of the Kulin Nation. I honestly can't believe there are less than 2 weeks until the end of the financial year. Just shocked. But we are, and so that makes it a really good time for us to talk about superannuation contributions. To do so, I've got our Senior Financial Advisor, Sam Kerr, here to help us out. Sam, welcome back to the show.
Thanks, Shelley. Pleasure to be here. Crazy that time's flying so quickly.
Incredible. So before we get into the show and before I forget, a quick reminder, please keep in mind that any advice on the show is general in nature, and so it doesn't necessarily relate to your personal circumstances. But if you would like to talk about anything, you can get in touch with us on 1300 623 863 or contact@nucleuswealth.com. And don't forget that at Nucleus Wealth, we offer personalized investment portfolios and limited investment advice. You can find out more about this at nucleuswealth.com or give us a call on the aforementioned number. All right, Sam. So where's the best place to kick off this discussion? Perhaps maybe with what concessional contributions actually are?
Yeah, sure. So concessional contributions are contributions made into your super pre-tax. Just to give a bit of context around that, you might be thinking, why make concessional contributions? And superannuation, it's a great place to save for your retirement. So it's effectively a low tax environment. So while you're working, super's taxed at a maximum of 15%. And then once you retire, it's a completely tax-free environment. So there's no tax on any earnings, no capital gains tax, no tax on any withdrawals. So it's a really, really good place to save for your retirement compared to saving outside of super. So that's why you want to get as much money as possible into that super environment, so you can save in the most tax effective way for your retirement, if that makes sense.
Absolutely. So just to put in perspective how powerful this actually is, off the top of my head, I think the lowest marginal tax rate is that 18%. Or am I well off there?
So the tax-free threshold is 18,200.
Right. And then after that, what do you pay?
So after that, it's 19 cents in the dollar.
Okay.
And then you've got the Medicare levy of 2 cents per dollar as well. Effectively, if you're earning anything over 18,200 per year, you'd be better off saving into your super. Well, it'll be a lower tax rate because that rate's 15% compared to 19 cents in the dollar, from 18,201 up to 45,000.
Okay, great. Thanks for clarifying that. So I guess what that means is it's a really powerful environment for that compounding effect that I know we've talked about on the show before. And as you say, to help you grow your money for retirement. And I think that's a really important one to point out, is that retirement aspect, which I know you've talked about in other articles. We're going to put that in the show notes about when to make that decision to save in super and outside of super, right?
That's right. Yep.
Fantastic. Okay. So, what constitutes an eligible concessional contribution?
Okay, so there's 3 main types. They're the SG contributions. They're your employer contributions. So your employer by law has to put 10% of your income into super. So that counts as a concessional contribution. Just so you're aware, at the time of this video, we're still in the 2021-22 tax year. And at the moment, it's 10%. But it is legislated to go up on the 1st of July 2022. So shortly, it's going to go up to 10.5%, and it's legislated to go up to 12%. It's supposed to go up 0.5% every year going forward. And then the 1st of July 2025, that's when it'll be set at 12%, and it's supposed to stay at 12% going forward from there. So as of now, it's 10%. So that's the first type of contribution. Second type of contribution is salary sacrifice. So this is on top of your employer contributions. It's an arrangement between you and your employer where they withhold part of your income and contribute that into super on your behalf. So that's how salary sacrifice works. And then we have personal deductible contributions. So that works effectively the same way as salary sacrifice, but you're more in control. You can put a lump sum into super, and then claim a tax deduction for that. So you can put a lump sum in. Let's say it's towards the end of the financial year. You can put a lump sum in up to your concessional contribution cap, which we'll touch on in a minute. And then you have to lodge what's called a notice of intent to claim a tax deduction. That contribution has to land in the tax year you want to make that contribution. And then once you've filled out the notice of intent to claim a tax deduction, you'll receive an acknowledgement from your super fund. And then when you lodge your tax return, that's when you're eligible to claim that tax deduction. So they're the three types. Was that clear? The last?
Yes, I think that was clear, but I do have a couple of questions, if that's okay, Sam.
Of course.
So when I heard you explaining each of those, it sounded to me like in the first instance with the SG contributions that you don't have to do anything. If you are employed, then the employer has to make those payments on your behalf. It might be a little bit different if you're self-contracted, is that right? But generally, in the first instance, you don't have to do anything to make sure those contributions are made.
Yes, that's right. So your employer has to put that 10% in by law.
Okay, fantastic. And then it sounded to me like in the second two cases for salary sacrificing and personal deductible contributions, you actively have to do something to make those happen. They won't just happen for you. You either have to go to your employer and ask for salary sacrificing, or go to your superannuation fund and work out how to get that money in there, and then lodge the notice of intent.
Yes, that's right. So if you want to make extra contributions into super on top of the employer contributions, that's where the salary sacrifice and the personal deductible contributions come in.
Okay. Yep.
They effectively work the same way, but they're just two. They have the same net effect, but they're just two different ways to get the money in there. You can sacrifice part of your pay each pay, or you can just put a lump sum in during the tax year.
And then the last question I had was, do you have to lodge a notice of intent when you salary sacrifice?
No, you don't. So that's all taken care of by your employer. I guess salary sacrifice is the simplest way to do that. And the personal deductible contributions, if you've got some money left over at the end of the year and want to put that into super, it's a good way just to put a lump sum in.
Okay, great. That sounds really clear to me that it just depends on your situation which one might be more appropriate for you.
That's right.
Fabulous. So let's move on. I remember you saying on the last slide that there were some limits to all of this.
Yeah. So each year, as of this tax year at the moment, 1st of July 2021-22 tax year, the concessional contribution limit is 27,500. Previous to that, tax years was 25,000. So let's say your employer, let's say you earn 100,000 per year. Your employer puts in 10%, which is 10,000. Then for that tax year, you've got another 17,500 that you can put into super. So that's a yearly limit. And it is indexed because it went up from 25,000 recently, but there's no set date at the moment for when that'll go up to 30,000.
So we just have to wait for the government to let us know.
That's right.
Okay, fantastic. All right, so I've moved on to this example that you have just started with the person that has $100,000 per annum, and in that case, the super guarantee from their employer would be $10,000 per annum. Do you want to keep running us through this? Because to me, it's a really powerful example. There's a lot of shows out there that talk about or not necessarily shows, there's a lot of content out there that talks about the power of these contributions in superannuation. But I don't know they necessarily always demonstrate it. And I think this is a great case where you have.
Yeah, absolutely. So, just for those viewers listening in on the podcast, you are able to actually go in and download the slides here. So, if you want to have a more in depth look and actually see the numbers, feel free to do that. So, yeah, the like that example I just started with, we'll keep the numbers round for simplicity. So let's say you're earning 100,000 a year, your employer SG contributions are 10% of that, so that 10,000. You've got your yearly contribution limit or cap of 27,500. So that leaves you 17,500 available for either salary sacrifice or a personal deductible contribution of 17,000. So they work, there's the same net effect, but in practice, they work slightly differently, like I sort of alluded to before. Salary sacrifice, that would be if you want to go right up to the cap, you would just organize with your employer for that to be put in on equal amounts over your year. So let's say you got paid monthly, so you just split that 17,500 up over 12 different payments, and that would automatically be put into super each month. Or we've got the personal deductible contribution where you just put in a lump sum of 17,500. So let's just assume we're doing a personal deductible contribution. It's the end of the tax year, you've got that money left over. So your income tax payable on 100,000 on your income is $23,767, and that's including the 2% Medicare levy. So if you were to put the full amount in for your for the year, the 27,500 up to the full cap, as a concessional contribution, as a personal deductible contribution, this would actually reduce your taxable income down by 17,500. So your new taxable income is 82,500. And then the income tax payable on that is $17,429.50. I hope you guys are still following me. It does get a little complex, but
It's
I'm
confusing that those numbers are so similar.
yeah, I'm going to do my best to
You're
make it
doing well.
clear.
Keep going. Thank you.
So straight away, you've saved income tax of $6,337 by putting that money into super. And then, but that's not the full story. So the 17,500 that you put into super, you have to pay the super contributions tax, which is 15%. So that's 2,625. So the net effect of putting 17,500 in is you after that super contributions tax is $14,875. So overall, you've paid $3,712.50 less tax overall. You've contributed 14,875 extra into super after tax. And the other great benefit is now your money's in that low tax environment of super. So you're only getting taxed at a maximum of 15% while you're still working, compared to investing outside at your marginal tax rate, which, if you're earning more than that 18,200, your tax rate is going to be much higher. So it's in that tax effective environment to grow. And then once you retire, it's a completely tax-free environment. So yeah, pretty good tax savings. And then you're also in that low tax environment of super.
Yeah, all right. That's great. I think you did a really good job of going through that, Sam. And thanks also for that summary at the end. Um, okay, so I know the next slide you've given us is exactly what we've talked about a couple times today, which is the marginal tax rates for Australian residents, depending on what their income is. So, is there anything further that you wanted to add about this one?
Yeah, so if you look there, the higher your marginal tax rate is, the more benefit that you get from saving that money into super. So I did the example of 100,000. You're paying tax at 32.5 cents in the dollar, plus the Medicare levy of 2%. And so the money that you put in there, instead of paying that 34.5 cents in the dollar, you're only paying 15 cents in the dollar. And then again, if you're on the highest marginal tax rate, earning over 180,000 a year, instead of paying 47 cents tax in the dollar, including the Medicare levy, you're only paying 15 cents in the dollar by adding those extra contributions into super. So some really, really great tax savings that can be taken advantage of there by utilizing these concessional contributions.
Yeah. So if you were planning to put that money towards your retirement anyway, it just makes so much more sense to have it in superannuation if you can, right?
Absolutely, absolutely.
Okay. We've talked about concessional contributions, but I know that one of the reasons you really wanted to do this podcast with me was that there's actually also this concept of catch up contributions. So should we move on to that? Do you want to kick us off?
Yeah, absolutely. So the catch-up contributions, they're still concessional contributions, but how it works is the government brought this in on the 1st of July 2018. So for the 2018-19 tax year. And it's a way to get more money into super, because at the end of the day, the government wants you to be financially independent. They want you to have as much money in super as possible. Otherwise, they're going to have to fund you through the age pension. So the more wealth that you can accumulate, the better in their eyes, because they're effectively moving the liability from the government onto the individual. So they brought in catch-up contributions. And how that works is each year we talked about your concessional contribution limit. So it's 27,500 for this tax year, 2021, 2022. But previous to that, it was 25,000 per year. So if your total super balance is less than 500,000, and you didn't utilize your whole concessional contribution limit for each of those tax years, you can actually catch up those contributions or use up any unused contributions from each of those tax years, and they accrue on a 5-year rolling basis. One other thing I just want to make clear is how to actually understand how much or how the amount of catch-up contributions you've got left is if you go onto MyGov and then go onto the ATO, it'll actually show you in there how much available catch-up contributions you've got there. And
It's really handy.
yeah, and you can do this through personal deductible contributions again, or salary sacrifice. And another benefit this has is it just gives you more flexibility. Like if you maybe only worked part time during maybe the last couple of years, and then you're back to full time again, you can sort of catch up on the contributions that you missed out on by saving some extra into super there. Yeah, so let's move on to the example. Same example, earning 100,000 a year. Let's say from you've earned that amount every year from 2018-19 tax year. You haven't made any extra contributions at all. So previously the SG rate was 9.5%. So your employer would have put in 9,500 each year. And then also the concessional contribution limit previous to this tax year was 25,000. So you can see there for 2018-19 through to 2020-21, you've got 15,500 of unused concessional contributions each year. And you can see on the right-hand column, they accrue each year. So you can see for 2021-22, if you've only made if your employers only put the money in, you haven't put any extra contributions, you've got an extra $64,050 that you can put in as a concessional contribution. So it's quite a significant amount of money that you can actually put in through these concessional contributions.
Yeah, that's a lot. All right. It looks like you followed on from this example in the same way as you did your example before. So shall I'll leave it up to you to go through that again?
Sure. Yeah, the available catch-up contribution is 64,050. Let's say you're still earning that 100,000 a year. So that would reduce by making that contribution, that would reduce your taxable income from 100,000 down to 35,950. So that's 100 minus 64,050, the catch-up concessional contribution you're putting in there. So that would reduce your taxable income from 23,767 down to $2,716.50. So that's a tax saving of $21,050.50, including the Medicare levy. So when you put the money into super, you don't have to pay that Medicare levy. That's why I keep mentioning it. So it's an extra 2% tax saving on top there. So on that 64,050 concessional catch-up contribution, you have to pay the super contributions tax, which is 15%. So the tax on that is $9,607.50. So the net effect, you've put an extra $54,442.50 into super, and you've paid $11,443 less tax overall. So that's quite a significant amount of tax savings. And it's a big boost to your super. And then again, your money's in that low tax environment of super to compound and grow, and really sort of save for your retirement in that tax effective way.
That is a big tax saving. I though do have a question, because in the example, the taxable income is $100,000, and we're making a contribution of $64,000. $64,050. So that's obviously a large portion of that. So who would typically potentially be able to utilize this current scenario?
Great question. So if you maybe sell a property, or you come into a lump sum amount, maybe you receive an inheritance, or just a one-off sort of lump sum that you come across, it's an excellent opportunity to get it into super in that tax effective way.
Okay, great. And I guess also maybe if you'd been saving for something and you didn't know about this, and the reason you'd been saving, maybe it went away and you have this money and you thought, oh, maybe I could put it towards my retirement. That might be another example too.
Yeah, absolutely. And if you've been often people aren't really aware of this, and when people really understand the benefits of super and the power of compounding, it's a good opportunity to shift some money that's outside of super and inside that super environment, so it can grow more effectively over the long term.
Yeah, right. Okay, fantastic. Okay, so that's some really great examples there that you've given us. Thank you. And I think maybe at this point, I'd just reiterate that you can download these from the show notes, the slides, if you haven't watched this on YouTube. So you can run through those and get an idea of how they might work in your situation. Or alternatively, or additionally, Sam has done a really great article that covers a lot of this stuff, and that's available on our website and our show notes if you wanted to go through that as well. All right, so a quick bit of housekeeping before we wrap up the show and say thank you and goodbye to Sam. So, if you haven't already and you did like today's episode, please click the like button. And if you're interested, you can also hit that subscribe button to follow the show and find out when we might have a new webinar to watch or go live. And also, all these things to help the show grow so we can keep bringing you more great content. So, Sam, as always, thanks so much for coming to share your knowledge with all our listeners. Can you tell them where they might be able to hear more from you or get in touch with you?
Yeah, sure thing. It's an absolute pleasure, Shelley. If anyone would like to have a conversation about their personal finances and investing with Nucleus Wealth, you can book a call with me through the Nucleus Wealth website, nucleuswealth.com/contact, and make a time that suits both of us, and always happy to chat.
Great. Thank you, Sam. So, before I say goodbye for today, if you have any feedback for me or the team about this episode, or even better, any ideas for future podcast topics, we'd love to hear from you. So, you can let us know in the YouTube comment section, or you can send us an email at contact@nucleuswealth.com. So, thanks again from myself and the team, and we look forward to catching you at the next one.